name is Adam Myers and I lead the distribution team at Pengana. Thank you for joining us slightly earlier than usual for this webinar update with George Latham, the Managing Partner at WHEB Asset Management, and Ted Franks, the Manager of the Pengana WHEB Sustainable Impact Fund. Today, George will provide a brief overview of WHEB and the single investment strategy that they implement both in their fund overseas and here in Australia in the Pengana WHEB Sustainable Impact Fund. Ted will then review the performance in 2020 as well as the drivers of the returns. He will also discuss his market outlook for 2021 and beyond. During the presentation, if you have any questions, please enter them in the question box and we will get to as many of them as possible in the Q&A. George, over to you.
Adam, thank you very much, and I hope you can see my slides okay as I'm sharing from my screen. But welcome everybody. Good morning or good evening from London. It's 10 o'clock in the evening here. And thank you very much for tuning in and joining us here today for this regular webinar to update our clients in Australia that we work with together with Pengana on the Pengana WHEB Sustainable Impact Fund. My name is George Latham, as Adam introduced. I'm the Managing Partner at WHEB Asset Management. I'm joined also by Ted Franks, one of my partners and also the Fund Manager for the fund. And we're going to take you through this morning. So just scrolling through, you've got the obligatory disclaimer, which I assume the slide's going to be sent to you because I don't think you'll have quite time to read that as we scroll through the slides, but I'll leave it there for a second. But really, I'm just going to start off by giving a bit of an introduction to WHEB and how we think about impact and sustainable investing within our investment strategy before I hand over to Ted, who's going to give a review of 2020 and then talk a bit more about the outlook as Adam introduced. So for any of you who aren't familiar with WHEB Asset Management, we are a single strategy investment boutique. We are a specialist around sustainable investment. And in fact, we have a business mission, which is to advance sustainability and create prosperity through positive impact investments. It defines our whole business centered around this single investment strategy focused on global equities with a mid-cap focus, but a strategy that's entirely focused on businesses, which we see as providing a solution to a sustainability challenge, and therefore businesses whose products are having a positive impact on society or the environment through their use. Our multi-thematic positive impact strategy has one of the longest track records in the market. It was first launched in 2005, and so we've been running for really quite a long time. In fact, some feel that we've kind of formed a sector that has really grown over the last few years, and we're acknowledged thought leaders in this space. The pictures on this slide are really of our impact reporting, which dates back to 2014 when we wrote the first ever impact report on a listed equity fund. And this has been an area where we've consistently led the market and innovated in the techniques as we've developed the techniques for measuring and reporting on the positive impact of our portfolio, as that ties into setting us forward to find strong growth themes in markets that we invest in. Some of those other logos define how we run our business, that we run our business to be radically transparent to the outside world. You'll find all sorts of information very easily, I hope, on how we run the strategy and what we're invested in that you might find more difficult elsewhere with other managers. We're a certified B Corporation, which means we embed the principles around ESG into the way that we run our own business. And obviously we're members and one of the founders members of the UNPRI and one of the highest scoring strategies, one of the highest scoring businesses within that organization. Our business has grown consistently over a long period of time and particularly rapidly in recent years. And we've been investing consistently in the team to grow and support that growing client base and to deepen our research on the companies and the market themes that we invest in. You can see there that last year we were delighted in this very difficult of environments to see continued extremely strong growth and see the strategy top £1 billion sterling or almost 2 billion now in terms of Aussie dollars. We've seen a number of people join the team over the last year. Most recently adding Claire Jarvis has joined the investment team to take that from 4 to 5. And we've added on both the operations team also and the client relationship management. So to just give you a brief couple of slides, just to give you an introduction into how we think and how we invest, because we are really very different to traditional global equity strategies, and even quite different to the way that many people approach the topic of ESG, or environmental, social and governance analysis and investment. I think this slide is really helpful to kind of set apart the way that we think and the areas that we're focused on. What we've done here is divide the market really into three areas of activity. On the left-hand side, under the heading of business at risk, you've got companies whose products or services cause harm. These are products or services that every time another unit of production is sold and used in the market, then that creates an environmental or a social damage or harm. There's a negative externality, which if it was entirely internalized into the profit and loss account of that business, could mean that that industry became unprofitable. And as we see ourselves as we see the economy at the early stages of a significant transition to a sustainable and zero carbon economy, we see consumers and regulators moving away from these industries, and we see that that area as being an area where you'll see a significant risk of real loss of permanent loss of capital in some of those markets, and the risk of stranded assets. But even in a more sustainable economy, we're going to need banking and transportation and clothing and food, but it needs to be sourced and manufactured and distributed in an entirely different way. And that creates a risk to profitability, and it creates a risk to growth. And so we see many companies that are where the products or services will still exist, but they need to change the way that they're supplied as being exposed to what we call transition risk. And these are companies where they may still exist into the future, but they are not, as of themselves, part of the solution. So although Unilever is a company which wins many awards for the way that it runs its business, we don't create a more sustainable economy by buying more shampoo or ice cream. So we're looking for companies where there is a lockstep relationship between their unit sales growth and positive outcomes for society and the environment. So we only invest in those companies on the right-hand side, where they're manufacturing wind turbine blades, or they're providing environmental services or technology to make transport or cars safer. So every time those companies that are listed there on the right-hand side, which make up less than 20% of the conventional market, every time those companies sell more of their product, that leads to positive environmental or social outcomes. And that creates an exposure to what tends to be growth markets, particularly as we see that transition to a zero carbon economy. But beyond just classifying activity that way, we go deeper and we explore the different dimensions of positive impact in the companies that we invest. This slide here sort of shows you the different questions that we ask of companies that we potentially invest in. Who is the client and how vulnerable they are? How critical is the impact to the client's future fitness, and so on and so forth? To understand these different dimensions of positive impact and try and assess the intensity of positive impact that we see in different situations. So for example, building renewable energy generation in the Nordic area, possibly displacing hydroelectric power and providing power generation to a wealthy population, is a good thing, but it is not as strong a positive impact as building renewable energy in a developing country, perhaps displacing coal-fired power generation and providing energy to an underserved population. So the same product could have a different intensity of positive impact in different situations. And so it's these different dimensions that we want to explore as we try to assess the intensity of each company or each investment opportunity's positive impact. That's one of the key ways and the structured ways that we understand the products that we're investing in. We also want to understand deeply the quality of the businesses that we invest in as well. And so we have an integrated approach to ESG throughout of our investment process, which understands how businesses are run alongside the financial analysis, which gives us a holistic picture of the quality of a business. So we're looking for high quality businesses in growth markets that have a positive impact. And that's the root sort of analysis within our fundamental analysis process in our investment process. The output is a portfolio of companies which is 100% focused on companies which fit this definition of solutions to sustainability challenges and having a positive impact. And the implications of having a portfolio that's organized that way is that we can measure and report on that impact to you and to your clients in our impact reporting. What we call our impact calculator is shown here on this slide, and it shows one way in which we can really change the way that we communicate about the outputs and the performance of our portfolio to our ultimate client base. So this is the output of a ground-up, stock-by-stock analysis through the portfolio that understands the positive impacts associated with each of our holdings, aggregated to the portfolio level and across the portfolio and across 8 metrics, which are both social metrics and environmental metrics. And it shows here on the slide the impact associated with $1 million invested in the strategy across 2019. We do this on an annual basis. We'll be publishing the 2020 report in the next few months. But we can show the impact associated with that $1 million invested, but we can also scale that up or down to any amount invested. That means that any client, any investor in the fund can look at the amount that they've invested and the positive impact associated with their own savings across the course of a year. And that impact calculator is available on Pengana's website and really enables wealth managers to build a different kind of relationship to their own clients and direct clients also to understand what their money's working towards achieving out in the real world. So I hope that gives you a very brief introduction to the overall structure and philosophy of our strategy. And with that, I'll hand over to Ted, who's going to take you right up to date in terms of how we've been deploying it over the last year.
Great, thank you, George, and thanks everyone for tuning in. Let me just share the screen. Obviously, seamless handover. Hopefully that's right. There's no one around to give me a thumbs up, but I'm gonna take it that you can all see that, so I'll crack on. So a couple of sections for me. We're going to talk back about 2020, and then we're going to look forward to what we think is going on now. And I have to say it's a slightly different setup. We do obviously strategies, whatever it is, 16 years old. We've given lots of annual outlooks, and this is not to give too much of a spoiler. This is the most positive we've felt for a long time. We'll go into a bit more detail about why that's the case. Appreciate this audience is I think a little bit mixed. There might be people who don't know the strategy so well. So hopefully as I go through the review, you should be able to get a bit of a picture of the way that we invest and some of the things that we look at as well. So every good professional capitalist likes to put a picture of a communist in a presentation if they can. Here's Vladimir Lenin, 2020. There are decades where nothing happens. There are weeks where decades happen. Well, 2020 was a year certainly where decades happen. I don't need to tell you that. You guys lived it as well. If you think about it from an investment point of view, the thing that's so striking for us is that big, ugly picture I've got there of the COVID virus should really be dominating. But actually, in terms of sustainability and in terms of perhaps history, looking back, you might even say that 2020 will be just as memorable for changes in the world's approach to sustainability. And what's striking is it's knocking very low interest rates, and in many senses, they perhaps have been the most determining feature in terms of market action, a big crisis in the oil sector, the most consequential US election in my life anyway, all of which took somewhat second billing, and Brexit was kind of a footnote. So it's really been a big year for things to talk about which feed into this kind of long-term sustainability view. Now, how do we do in the year? Well, here's the sort of raw number. We benchmark ourselves against the MSCI World, which is just a general, we always want to be compared to the sort of general returns from equity investing in developed markets. It was a good year for us. We fell marginally less during the downturn, but we couldn't claim to be particularly defensive. But afterwards, you've seen this fairly solid piece of outperformance as the year's gone on. And the reason that we see that, and we'll come on to this in more detail, is that really the pandemic was an accelerator of some of the sustainability trends and a real vindicator of some of the key things that we look at in terms of future-proofing where our investments are. I'll just take a quick tour through the way that we think about how our performance was. We have 9 themes that we invest in, 5 of them environmental, 4 of them social, and every period that we look at which themes have done better and worse. And the story in 2020 is that we had good contributions from lots of the themes. We also had that grey bar halfway down, thematic selection effect, that represents the attribution to the benchmark, which isn't in our universe. So that's whether sustainability was a headwind or a tailwind in the corner in the year. It was definitely a tailwind in 2020. But down at the bottom there, sustainable transport, well-being and education, they were negative contributors. I'll talk about one of those in detail, and obviously happy to take questions on the rest. But returning to this idea of the pandemic as a sustainability vindicator and sort of accelerator, there's three sort of key ways in which we saw that that was the case in terms of changing the world's perception of thinking about health, safety, and resilience. Two of these are explicit themes of ours. They speak into sustainability, and particularly sustainability as we define it, which is to have the human being at the center of it. It's about the sustenance of a decent quality of human life. And then the resilience aspect was sort of almost unexpected for us, but came through in some of our industrial companies and some of the themes there in terms of actually the companies that we invest in providing solutions to sustainability challenges also fitted with the pandemic. And there's no real better example than this one. We invest in factory automation and advanced logistics. It's in our resource efficiency theme. You're talking about significant energy savings, some material wastage savings. That's not such a big thing, but you know, these factories and facilities, when you have eliminated human operator error, you don't have to light it, you don't have to heat it, everything's done to precision, you've got big energy savings, order of magnitude 20 to 30%. That's why we invest in Daifuku and Kion. When the pandemic hits, these companies are also providing resilience in a sort of lockdown friendly environment, and on top of that you get the extra gravy for us of the e-commerce trend emerging as well. So it was a good year for that kind of thinking about how the world should operate. The health theme also had a strong year. We've been invested in the three large life sciences tools companies, Agilent, Danaher and Thermo Fisher, for nearly a decade now. They were very much smaller when we first got in. COVID for these guys was both exceptional and not exceptional. On the left-hand side, Thermo Fisher have been very kind, and they've broken out the proportion of their revenues, which was excess as a result of COVID in the year. And you can see it was without doubt an exceptional event. But on the right-hand side, the world is absolutely in an incredible discovery phase in terms of therapies and scientific developments around health. It's a 45-degree line upwards since the turn of the millennium. We put in a little dotted line there too. You can see if you carve out the new COVID therapies, the vaccines and so on, okay, there'd have been a slight dip, but of course no one could relaunch new trials. So actually without COVID, it probably would have been the same line anyway. So it's exceptional because it had the one-off effect, but the world needing more diagnostic and science tools generally to solve sustainability issues that's just a long-term trend. The other aspect which we thought was very interesting was changing human behavior and changing patterns about how we interact with each other. And of course, it's slightly ironic sitting here in lockdown London talking to you guys for whom it's been much better. And you know, I'm very pleased for you that it has been. But even still, the whole world, much as the victims, the places which suffered from MERS and SARS and avian flu and the sort of pandemics since the millennium, we're now taking a new view about how we interact with each other and where we can save needless healthcare risks and costs in terms of safety and hygiene. And several of our companies have offerings which feed into that. Ecolab example here is not even in our safety theme, it's actually in our water management theme. But it's products which we like because they're very good for saving energy and water, because they're very effective chemical detergents effectively. But of course, now they have a whole new strand of opportunity as well. And again, it's this sustainability thinking overlapping with pandemic thinking. Now on to the negative side, and obviously always happy to talk about both sides of our performance. Education, it wasn't a great year for the education theme. So we talked a little bit earlier on, I talked a little bit earlier on about automation. We very much see that the world of work is changing and that there's real tension and pressures on people as they build their careers. We're interested in education and lifelong learning. We've got a couple of investments in the for-profit sector in the US of higher education. We're very, very careful about them. These are companies which specifically cater to very disadvantaged cohorts. It's not been a good time to run any kind of education, even though our guys were very good and our leaders in the digital side, they still have physical operations which didn't do so well in the pandemic. And in addition to that, it was an interesting year to be invested in anything which had a political overtone in the US. These stocks actually are traditionally considered to do better in Republican administrations. The two mugshots here are the outgoing education secretary and the nominee for the Biden administration. They really represent very different regulatory shifts, but we're confident that the companies we invest in provide quality solutions and have a good long-term horizon. It's worth saying in passing, you know, our average hold period in this fund is kind of 7 years. We think long-term at the moment, that's maybe a bit over the top, but certainly we think in kind of 4 to 6 kind of is our intention. We think that being a long-term investor is a big part of the promise of being an impact investor, to try and support these companies as they do good things. So those are some of the sort of big headline things in 2020, but a couple more, and we'll come to the sort of perhaps the biggest one is the slide after this, but always worth talking about climate change adaptation. Climate change is here, it's very real, it's absolutely got economic effects. There's a change in the policy shift, as we'll come to, but charts like this one from the National Oceanic and Atmospheric Administration in the US, this is the number of storm events which cost more than $1 billion to clean up. You can see each year there are more of these than previously. The current year is the red line to the point at which the data currently exists. We've got plenty of companies in adaptation. We've got 3 of the logos here. You know, this is just an incremental organic tailwind for these guys, which is meaningful and serious in the world. As well as solving and reducing emissions, it needs to adapt as well. Reducing emissions, a segue to one of our themes, the third best contributing theme for us and a small theme for us, cleaner energy. Now, quite a lot of people on the call will have noticed these are funny times in markets. I'll talk in a second about the incredible change in the opportunity set in the transition. That has resulted in a lot of enthusiasm for renewable energy stocks amongst other stocks. On this chart, we've got the renewable energy index going back, and the strategy's been long enough now that we can remember this as well. It's old enough that we can remember this. 2007 was the previous peak, and really it was a I don't want to be too strong, but a bit of a disaster for the sector, and in a way a disaster for the fight against climate change, because that crash was so significant that even now, in absolute terms, we've only just about getting to halfway to what the peak previously was. The difference now, if you look at the green line, which is the valuation of the stocks, it's completely through the roof, and it owes something to the opportunity set, but it also owes something to this incredible interest rate environment, the options trading, the retail trading, the Bitcoin, GameStop, that kind of phenomenon as well. And we're just watching it very carefully. It's good that people are enthusiastic about the sector. It's not good if it results in a crash. So we're sort of hopeful that there's some kind of resolution there. So hopefully that made 2020 pretty clear, and also has given you a pretty good idea of the way that we think and the way that we invest. Now, what's going to come in the outlook, with, you know, some apology for this. This is a pretty it's a pretty unusual outlook in the sort of 16 years of the strategy, and it's kind of relentlessly positive, and that is because there has been a very significant shift in terms of the policy setting around really the key sustainability issue at the moment, which is climate change. It's not the only issue. You know, land use, biodiversity, water, plastics, there's all kinds on the environmental side, tons on the social side, diversity, inclusion, equity, mental health, all kinds of issues as well. But I think we can all agree climate change is kind of the big in the wheelhouse. We've got to solve it. So what happened? Well, the UK unusually slightly in advance in 2019, but obviously we're very pleased that we did that. First half of 2020, the Europeans took up the baton and got into these commitments about carbon targets, and then particularly China, obviously such a huge deal. The second half of last year into the sort of fourth quarter, China, Japan, South Korea, then the American election victory. Biden hasn't got a target yet, but he's rejoined Paris on the first day. Clearly, this is a sea change in the policy setup, and you know, obviously, the sort of NGO world is abuzz with it. This is fantastic graphic produced by this very good NGO, Climate Action Tracker. They've got the thermometer. See on the left-hand side how they were thinking at the end of 2019, and this is what will the temperatures get to by the end of the decade. And the optimistic policies, then they were saying 2.8 degrees of temperature rise, and frankly, with the variation on that, I mean that's kind of terrifying. They've said in a year's time, you know, within only a year's time, they say actually, you know, potentially if these things actually work out, we could knock 0.7 degrees off that. So it's a pretty significant change. We're going to have to bend the curve faster than that, but it's the first time we've ever seen it go down, right? Like it's the first time that there's this sense of optimism, and that's key for the strategy as well, because the whole point of our strategy, it's not just a clean tech strategy, it's not just a water strategy, it is a holistic sustainability strategy, and it has lots of different solutions to different sustainability challenges, and all of those will be part of putting the jigsaw together to try and get the emissions down and try and bend that curve. Here are some of the verticals with some of the companies that we invest in, and I'll take you through a little bit more slowly through the ones which we think have experienced effectively a change in kind of outlook in 2021. Energy first. Obviously, we've talked, there's a little bit of froth, quite a lot of froth around the sector at the moment, but underneath it, there's a very clear story. There's a technological pathway for decarbonising energy. Energy is the single largest source of global CO2 emissions. You don't have to worry. Nuclear will potentially have niche applications. Carbon capture's not going to get there. Geothermal, wave, tidal, don't worry. Solar's going to do it. Wind is going to help it on the way down. There's still a good future for wind. The pathway is there. Our two companies that invest in the wind sector, Vestas and TPI Composites, work together to bring this blue line down. That's the cost of renewable energy from Vestas wind turbines. And TPI does it by increasing the length of the blades and the sweep area to try and make them more efficient. Huge opportunities for these guys now, particularly as offshore wind gets going. Transport, the second big source of emissions, a big exposure for the portfolio, sort of 12% all told, one way or another in the EV transition. It seemed to us that in 2018, it seemed that the transition would be quicker than everyone was talking about. You know, all the vested interests who wanted to say this wouldn't happen for a while. I guess that the sort of, if there was an insight, it was that people don't buy cars where they don't know what the end value is going to be. Now, last couple of years with trade tensions, also volumes dropped off, but now what we're seeing is this very clear change. So let's talk about the lines. The lines going down are diesel and petrol cars. These are UK data. The dark green line at the bottom is the so-called mild hybrid, which is kind of the excuse for more efficient fossil fuel burners. But look at the blue line. This is electric vehicles, including hybrids, admittedly, but really the action in this is battery electrics. And you can just see that inflection happening now. The enthusiasm for EVs is far greater than the market thinks. We've got good exposure to it. Some of the names are in the logos there. Decarbonising industry, the third segment of emissions, a tricky one, difficult to get it out. It's all incremental gains. The good news is that industry is all about incremental gains. It's full of people who work at fine margins. We've talked actually already about Kion and Daifuku. A lot of the investing here is around advanced industrials and robotics. You know, Kient's on the left-hand side. It's been in the portfolio again for a decade. It's a machine vision company, quite striking what you can do with your factory with Kient's. But there's a lot to go for there in terms of emissions, and we're well invested in it. And it tends to be that you can find nice companies with nice defensive moats in good niches there. Food, another huge challenge, mostly because it's going the other way at the moment and the world is eating more of the carbon intensive food, and particularly meat. We do need to eat less meat. The company on this slide, DSM, has additives which help for non-meat food production as well. It's also got this feed additive called bovver. You feed to cows and it stops them belching quite so much methane. In fact, significantly less methane, a sort of 75% reduction. So that's a big part of bending the curve. The challenges for food are much greater than that, and we're actually always on the lookout for further food investment opportunities around decarbonisation. There will be more, but it remains kind of along with aviation a really nubbly question. These are the sort of last two really difficult areas to decarbonise in our eyes, which leads us actually to this category, buildings. This shouldn't be perhaps as hard as it has been. The green line here is global emissions from buildings, and you can see we haven't yet bent the curve down. It needs to go on the dotted line downwards. There's a lot you can do with buildings. The key problem, of course, is that a lot of it has to be retrofit, and then the economics get into what kind of yields people want on their buildings. But we invest in the companies that provide the solutions to do that, whether it's insulation or, in this case here, Lennox and Daikin, which do heating and cooling equipment. That piece of machinery is an air source heat pump. It's a way of generating heat from electricity rather than fossil fuels. And the future for that is very, very bright, and it's in a lot of stipulations for new building standards. Excuse me. Sorry, a little bit dry here. Okay. So if that is a sort of run through of the thematic exposure, all of which underpinned, always has been, by the need for these solutions, but particularly this year, now that we have at the top level the company-wide net zero carbon commitments, and kind of below that, companies wanting to commit to go net zero carbon. A couple more thoughts about 21 in particular. Now, we are going to see a cyclical recovery. We've also got critically, historically low interest rate environment. And on top of that, you've got this new mandate towards sustainability. A lot of the companies we invest in are industrial companies. If you're going to solve environmental problems, you have to interact with the environment. and you do find that a lot of that is done by industrials. They're sort of capital items. We think that there should be a case for a cyclical recovery that is green. So this idea of building back better and greener, and that also is potentially a cause for enthusiasm. I don't want to sort of overstate that. There are obviously big question marks about the state of the global economy coming out of the pandemic as well. So it might be that the scarring is very deep, but we think there's certainly cause. If ever there was to be a green agenda, a good time to pick it up is when balance sheets are pretty strong for those that haven't had very bad experience of the pandemic, and now that the pathway is very clear as well. And then the last of my sort of topic slides, this idea of the deepening ESG agenda, environmental, social and governance agenda. And I think we can see now, perhaps crystallized by climate change, because it's such a big issue and it's so in front of everybody, but all those other sustainability issues I talked about before, there is really a change, a societal change in the way that people think about these issues. And I think we can see that not just the pressure on companies that consumers use to be seen to be good citizens, but the pressure that governments now place on them, and the willing and voluntary decisions that their leaders want to take in order to be better citizens and to contribute to solutions and to transition themselves, is all good news really for investing in the companies which are the solution providers and are in that chain. And in addition to that, obviously, the imperative is there when you own a company, even as we do, because it does something good, to check that the way it does it is a fair and just and equitable way under the sort of good ESG principles. So this is all the future. It's, as I say, really as positive now as it has been in the entire existence of the strategy. And I will show you those, which are the long-term performance numbers, and happy to take questions on that. Again, this is the MSCI World, just the general equity index, which includes, of course, a whole range. I mean, our crossover with that is our active share is 98%, but it's a sort of standard that we want to hold ourselves to. And with that, I think we go to questions. Thank you for listening.
Great, thank you very much, gentlemen. We have a number of questions. I'm going to try, where possible, to group them in ways that make sense, but that strategy may not work out quite as well as planned. First question is relating to the mindsets of businesses and companies. Are you seeing that companies are recognizing the importance of a sustainable approach and moving from degenerative to transitioning and potentially to positive impact?
Well, I mean, I can have a go first. Yes, there has been no question. Our own journey with the way that we wanted to invest in companies over the last 15 years, and the way that the companies have responded to us has been very, very marked. And really, in the last couple of years in particular, not just that investors have matched it, and obviously people and individuals have matched it in their lives, but the companies have really moved strongly this way. It's fair to say that actually, kind of strategically, the more alert ones were already getting there. I think you'd sort of say 2014 and the end of the last big commodity bubble, and that's when you started to see corporate agendas which were much more progressive, I think, than the other stakeholders had in mind. And there was a big period, which still is sort of ongoing, where companies would spin off their sort of legacy, less sustainable businesses. They'd invest in the transitioning businesses. They'd buy and build transitioning businesses, and it became a kind of strategic imperative. And of course, those companies now are being rewarded because there's quite a big multiple advantage to having done so. So the slide that George showed at the start with the degenerative, transitioning and impactful, the market, all of industrial thinking is migrating from left to right, or a lot of industrial thinking is migrating from left to right in that chart.
Thank you. George, possibly one for you. Can you describe the differences between your health and well-being themes?
Yeah, sure. The health theme actually is not what you'd expect from looking at GICS health. So the important thing to say about our health theme is that, as with all of our themes and all the stocks in the portfolio, we're focused on this definition of being companies where the product is a solution to a sustainability challenge. So within health, we tend to find not very many pharma and biotech companies that fit our definition. We tend to look more at preventative care, helping to cut the costs of delivery of healthcare. So healthcare IT or health services, care for the elderly and so on, or dealing with the challenges of obesity and so on. The well-being theme is quite an aggregated theme, but it looks after sort of healthy lifestyles. I think we've called it, there's a phrase called LOHAS, which we've used for it before, but it's not one that's recognized by everybody, but it stands for Lifestyles of Health and Sustainability. But it's really care for the elderly, care for the young, sustainable foods or organic foods, and healthy lifestyles like fitness and so on and so forth. So that would be the distinction between health, which is more about health and healthcare and healthcare solutions, and the other, and well-being, more about lifestyles.
And while we are talking about themes, is there a possibility that your themes will change through time? You just stressed the importance of decarbonizing food. Should we expect something around that coming in?
Go, George. Yeah.
We've had this broadly. We've had, and the top definition I just mentioned of looking for companies where they're providing a solution to a sustainability challenge. That top definition has remained unchanged for a long time. And actually, the 9 themes that we invest in, the 5 environmental themes and the 4 social themes, that's been unchanged for a long time. Beneath that, there are something like, Ted will correct me, but 27, 28 sub-themes or so that we invest in. And there you get some change as markets develop. So within the resource efficiency theme, that's quite heterogeneous. There's both about efficient manufacturing, efficient materials, using IT to improve efficiency, and so on. But you get new technologies which bring in new end markets, new sub-themes that we identify along the way. But we're not closed to the idea of new themes to join the 9. But we've found that the 9 are quite a useful way at the moment of being fairly consistently a useful way of categorizing what we have. But there are some areas that we'd like to see themes develop in that could become investable markets. For example, biodiversity, sustainable foods. Those are areas that we in principle would like to see, but they're not really investable markets, certainly not in the context of listed equities at this stage.
Great. And the last question about themes, and I'm not exactly sure who to address it to, potentially Ted, is if solar is going to do it, as you said.
That's a scientific term.
Why are you invested in wind and not solar?
So we have a pretty, obviously well-established investment process, goes back quite a while. Obviously, impact is how we lead into things, but we like quality companies because we like to be long-term investors. We like to, effectively what we're trying to do is find a company at the adoption point of a technology that it owns that's about to be popularized and really solve a sustainability challenge. But when the company is a safe enough bet and has established good barriers to entry and has got a nice competitive position, you can see that they're a high quality company as well. And then we do have valuation discipline about that too. So we're not just going to pay up endlessly for it. That's not been a problem heretofore with the solar companies. They'd be cheap, but cheap for a reason. It's a commoditized manufacturing industry. It has a lot in common with the semiconductor industry in the 80s and 90s. And it has been, I think as the chart I showed you, the 2007, there's been a wreckage in the solar industry for a long time. There are some signs of consolidation, but there are always some signs of consolidation. There are little bits of the solar value chain which have better competitive dynamics, and that's principally inverters, which is the device which changes the current so that it can feed into the grid. Those companies are very, very expensive indeed, and that's so value is what stopped us there. We're always watching this because we'd love to have some involvement with solar, but at the moment, the investment side is what's holding us back there.
Great, and sort of that leads well into another question here. You mentioned a concern about valuations of some of the clean energy stocks, and yet you continue to hold them. What sort of valuation movements will it take to make you change your mind?
Yeah, so the 2 stocks that I mentioned, are somewhat an active watch for us. We are constantly discussing where we think the positioning is now. We're obviously an impact investor. We want people to invest with us because their money is having an intention. We're at the cusp of this big transition, going to a place where we, on principle of valuation, would not hold cleaner energy is quite challenging for us. I think it's fair to say. I think there is a limit to that, clearly. I I think we can see, certainly in the case of Vestas, it's very, very hard to see if anything happens in hydrogen that even at these levels. So if anything happens in hydrogen, what that means in terms of the scale of renewable energy to generate the green hydrogen would be so great that it's very difficult to see Vestas with its position not benefiting from that. And actually there's quite, we think that that's probably more likely than not. And then TPI Composites has got an additional growth strand as well in its transportation business, which we think is underappreciated. But certainly both of those companies are right up at the point where they're under kind of constant review. As long-term investors, we do try and absolutely maximize, and we try to exit a stock at the point where we're convinced that that adoption curve has ended and the best point of the growth is out of the way. And obviously that's clearly not the case in this instance. We're not, if you just go by value, then you, by definition, you end up being moved in and out of stocks on a slightly shorter time frame. So we tend to have a little bit of patience as stuff runs up. But even having said that, those two names are definitely things that we watch carefully.
Excellent. And another question for you, Ted. Most of the stocks that you invest in are small and mid cap and are probably the kinds of stocks that would be popular with the Robinhood trader demographic. Is it a concern that this could have contributed to your performance last year, and could this activity be distorting the valuation of your holdings?
Well, that's a really good question, and quite a sort of deep one, and we get into an area that we, although we're thematic investors, well, I guess we're thematic investors which goes through a bottom-up lens. So we have the themes that we want to play, and then fundamentally we pick stocks which will actually work in those themes. And that question is a bit more of a sort of equity strategy question, but it is, of course, our job to look into that. I think our observation would be, in the numbers that I have seen, the real favorites for the sort of Reddit crowd are actually not the high quality mid caps with the good balance sheets and the stable positions. What they've gone for is this signal with low interest rates that actually kind of anything, it's not quite a dash for trash, but it's kind of anything which was previously marginal is where the real heat has come in from those stocks. And there's no penalty for volatility, there's no penalty for excess risk. And we're not quite in that group. Now, that's not to say your point isn't a good one, because there are definitely themes which those traders like, which we're part of. And again, it's very intense in the cleaner energy side. It does feed through various bits of the portfolio, but we think that, well, we're constantly evaluating. We think that because of the change in the transition, the change in the backdrop of the transition, we're happy that we're not just benefiting from that trend. And I would say, by the way, I mean, we obviously keep a sort of a weather eye on other ESG strategies. We are definitely still, we're a GARPy strategy, but we're definitely still at the value end of the ESG strategy as we see it, certainly in the opportunity set, which I guess maybe London's perhaps slightly different, I don't know, but when we look at where the ESG market has got to, we seem to be better at pulling it back a bit valuation wise.
Okay.
Interesting question. Sorry, long answer. Interesting question.
No, it was definitely comprehensive.
Sorry. Yeah.
So George, I think this one might be one for you to answer, but one of the reasons for optimism about the strategy and the world in general is the zero carbon commitments. But so far, only the UK has passed these commitments into law. All the other countries have drafts and proposals. So is the extent of the current optimism really justified?
Am I right? Is that right, Adam? I think the EU has passed into law their own commitment for to target zero carbon by 2050. There have been. It is extraordinary how rapidly this agenda around net zero carbon commitments has taken off. I think it was the last act of Theresa May and the UK government to make this commitment for the UK to achieve net zero carbon by 2050. That is now that got taken on. We were one of 500 companies that announced a commitment by 2030 or earlier. We actually made a commitment on our own account by 2025 at the end of 2019, and then you had commitments from really major companies like BP, Sky, and others early in 2020. And then you had a commitment from China as well last year to make zero carbon by 2060. The momentum around that is almost creating something of a sort of race to the top, really, of people competing to get there sooner than the next person. The challenge is that I don't think they've all defined quite what they mean by that. So you've got really large pension schemes or really large fund managers making commitments around their own portfolios. And indeed, we were part of a grouping that made a commitment around our portfolio emissions to work towards net zero portfolio emissions by 2050 or earlier, with some really quite stringent interim targets before that. But really defining quite closely, and we've been quite public about this, about what we mean by that in terms of the levels of giving really structured and close commitments to what we expect to achieve in terms of seeing written commitments by our portfolio companies and the levels of engagement that we can have within the portfolio. But I think this is early stages, and I think what is exciting around this is that it's taken off really very quickly. That that original commitment in the UK from Theresa May is not that long ago. A lot has happened since. It's not all clearly enough defined yet, but I think we're on a path to see that happen, and that gives a framework through which we can see real progress made.
Great. And we have one last question, which I'm going to address to you, Ted. And that is, given your view about electric vehicles, do you have a view about the prices and availability of lithium and cobalt and other minerals? And could the fund ever invest in them?
Yeah, great question. The fund absolutely could invest in them if we consider that they are providing, uniformly positive impacts. Obviously, these are extractive industries, so we always have to balance what we're seeing of the supply chain. I think it's worth saying that cobalt is very my understanding, which is not super detailed, is that cobalt's not only difficult to find listed equity which is attached to it, but also that's a very troubled supply chain, so that would seem unlikely for us to invest in. Lithium's much better established. There are 4 or 5 big listed companies, and they have big valuations at the moment. So whilst the lithium spot prices are still heading downwards globally, or have been in a downward phase for the last sort of 18 to 24 months, those have appeared to be very thematic and potentially overvalued investments. So there's kind of an investment reason not to invest sort of right now. More broadly, our style is companies which have a piece of technology and really kind of a piece of IP around something they do, and they can build a nice defensive moat around it, and we can get on board and invest in them for the long term. If you invest in Albemarle, which is one of the lithium plays, you are playing the lithium price, and we tend to shy away from companies that are too closely linked to a volatile commodity price, because then you're obviously analyzing the commodity price rather than analyzing the business model. We'd still do it if it was impactful enough. For reasons I've just mentioned, we've had a look at the space, we keep an eye on it, and at the moment we don't really think that all the pieces fit together for that.
Great. Thank you. That makes sense. So we've reached the end of our questions. Thanks to George and Ted for staying up to present to us this morning.
Thank you for having us.
George provided a brief overview of the strategy, but looking at the list of attendees, I see a lot of new names on the list. So if you would like more information about the underlying philosophy, the investment strategy, the universe, please get in touch with us. We love talking about the strategy and would welcome an opportunity to provide more detail. And that's it from this webinar. So thank you very much for attending.
Thanks, guys.
Thanks.